everyone, this video is to explain the importance of including adjusting entries and what happens if you omit. I'm really hoping that by the time you get to this video, you'll understand the process of adjusting entries and which accounts are affected. And once you've got that, this will make a little bit more sense to you. So again, there's 5 different types of adjusting entries that we have to do, and I'm going to talk about each one and how they affect the financial statements at the end of the month. What I've done is I've opened up the PowerPoint on the adjusted trial balance, because what I want to do is use this trial balance in my explanation. So again, a trial balance shows us if our debits and credits are in balance at the end of the month, which means that our teeter-totter is in balance. What it doesn't do, though, is tell you if you have omitted any of these adjusting entries. That doesn't affect the trial balance. What it does affect, though, is the financial statements, which are the next step. So the first type of adjusting entries we learned about were prepaid expenses. Now remember, prepaid expenses are really what we call our current assets. So accounts receivable, supplies, prepaid insurance in this particular example. Cash is never affected in adjusting entries. If we don't record our prepaid expenses properly, so let's say that we've used up $500 worth of our supplies this month, if we don't take that $500 out of our asset account and put it down here into our expense account, then our assets will be too high or overstated, and our expenses will be too low or understated. If our expenses are understated, when we go to calculate our net income, which is revenue minus expenses, then our net income would be too high or overstated. So when expenses are too low, net income is too high. The next type of adjusting entry we learned about was unearned revenue. Unearned revenue, if you remember, is when a customer pays us upfront for services we haven't yet performed. So when we first receive that money from the customers, it's a debt or a liability that we owe to them. So one example on this particular trial balance is unearned rent. In unearned rent, we have $240. If we performed, let's say, $60 of that liability, if we provided rent worth $60 to that customer, then we have to take $60 out of our unearned rent liability and put it into our rent revenue account. So it has to come out of liability and go into revenue. If we don't record this adjustment, then our revenue will be too low or understated, and our liabilities will be too high or overstated. If our revenue is too low, then again, when we calculate our net income, which is revenue minus expenses, our net income will also be too low or understated. So if revenue is too low, net income will be too low. The third type of adjusting entry is accrued revenue. Accrued revenue, if you remember, is when we perform a service but we haven't billed the customer yet, or they haven't paid us yet. So in this example, nothing would appear in the trial balance if we forgot to do this adjusting entry, because there's no revenue recognized until we bill that customer. So we have to really pay attention. If we forget to include our accrued revenue, then our revenue is going to be too low or understated, and our assets, our accounts receivable, will also be too low or understated. So again, if we forget to include accrued revenue, our revenue will be understated or too low, and our accounts receivable or our assets will be also too low or understated. When we go to calculate our net income, if our revenue is understated, our net income will also be understated or too low. The fourth type of adjusting entry that we deal with is accrued expenses. Remember, that's if our employees have worked for us, but we're not actually going to pay them until next month. So that means that our expenses, again, would be too low or understated, and our liabilities would also be too low or understated. So our wages expense would be too low, and our wages payable would be too low. They would both be understated. As I said in the last one, If our expenses are too low, revenue minus expenses equals net income. So if our expenses are too low, our net income will be too high or overstated. And the last one is depreciation. Again, when we purchased a capital asset, we always have to put it on the books at the value that we purchased it at, $1,800, and that can never change. But what we do to show people that it's not worth the same value is we create this other special account, that contra asset account called accumulated depreciation. So in that, we have to record how much we feel the equipment has depreciated over the month or the year. So if we said it depreciated another $50 over and above what we have here, we would have to put $50 here and also $50 down here in our depreciation expense. If we don't record this transaction, then our expenses will be too low and our assets will be too high. Our expenses will be understated and our assets will be overstated. Again, if our assets are too high and our expenses are too low or understated, then our net income is going to be overstated. Net income is revenue minus expenses is net income. If our expenses are too low, then it's going to appear that we've made more money than we really did, and our net income is going to be overstated. I hope this makes sense to you. Please watch this as many times as you need. It is a bit tricky concept, but I'm sure you can get it. See you soon.